No more income taxes. The 10% Trump tariff explained. Imagine a world where you don't have to pay income taxes. No more tax forms, no more deductions, and no more IRS headaches. Sounds like a dream, doesn't it? Well, this radical idea could become reality with a bold concept linked to Donald Trump. The 10% tariff on all imports. Could this policy really replace income taxes? Today, we'll break it all down. How does it work? What does it mean for you? And is it even feasible? Let's dive in. Segment 1. What is the 10% Trump tariff? So, what exactly is the 10% Trump tariff? The idea is simple on paper but revolutionary in practice. Instead of collecting income taxes from individuals and businesses, the U.S. government would impose a flat 10% tariff on all imported goods. This tariff would supposedly generate enough revenue to replace federal income taxes completely. Sounds straightforward, but there's a lot more to it. Think of it like this: every product imported into the U.S., from cars and electronics to clothing and furniture, would face a 10% tax at the border. This tax revenue would fund the federal government's operations instead of relying on the income taxes we all pay. Proponents argue it's a game changer for simplicity, fairness, and economic growth. But can it really work? Let's explore. Segment 2. Why replace income taxes? First, let's talk about why anyone would want to replace income taxes. Income taxes have been the primary way the federal government raises money for over a century, but they're not without problems. The tax code is incredibly complex, with over 70,000 pages of rules. Taxpayers spend billions of hours and dollars filing their returns every year. High income tax rates can discourage work, savings, and investment. A flat tariff like this promises to simplify everything. No more filing taxes, no more IRS audits, and no need to navigate complicated deductions or credits. But there's more to the story. Segment 3. How the 10% tariff works. Here's how the 10% tariff would work. Instead of taxing your income, the government would collect taxes at the border on imported goods. For example, if a company imports $1 billion worth of goods into the U.S., it would pay $100 million in tariffs. That money would go directly into government coffers. The idea is that this revenue could fully replace the $4.9 trillion the federal government currently collects annually from income taxes. Supporters of this idea argue that it has several key benefits. 1. It simplifies the tax system. 2. It encourages domestic manufacturing by making imports more expensive. 3. It puts more money back into the hands of workers and businesses by eliminating income taxes. Segment 4. The potential benefits. Let's take a closer look at the potential benefits of this policy. First up, simplicity. The U.S. tax code is infamous for its complexity, costing taxpayers and businesses billions in compliance every year. Switching to a tariff system eliminates this burden. Imagine never having to file a tax return again. Secondly, a 10% tariff could incentivize domestic manufacturing. If imported goods are taxed, producing items in the U.S. could become more competitive. This could create jobs and boost industries like manufacturing and agriculture. Lastly, for workers and businesses, this system could mean higher take-home pay. Without income taxes, your paycheck is yours to keep. For businesses, lower taxes could mean more investments, innovation, and growth. Segment 5. The challenges and criticisms. Of course, no policy is without its challenges, and the 10% tariff is no exception. Let's talk about the criticisms. First, higher prices. Tariffs make imported goods more expensive. That cost is often passed on to consumers. So while you'd save on income taxes, you might pay more at the store. Second, trade relationships. The U.S. trades heavily with other countries, and a 10% tariff could lead to retaliation. Countries might impose their own tariffs on American goods, sparking a trade war that hurts exports and global trade. Third, there's the question of revenue. Critics argue that a flat 10% tariff might not generate enough money to replace income taxes, especially if imports decline due to higher costs. Could this lead to deficits and cuts to essential programs? Segment 6. Real-world comparisons. Has something like this been tried before? While no country has replaced income taxes entirely with tariffs, there are examples of alternative systems. For instance, Singapore, a low flat tax rate combined with high consumption taxes, simplifies their system. Middle Eastern nations, many rely on oil revenues instead of income taxes to fund their governments. These examples highlight that alternative revenue systems can work, but each comes with unique challenges. Replacing income taxes with tariffs is uncharted territory, especially for an economy as large and complex as the U.S. Tariffs impact. The imposition of tariffs, especially those proposed or implemented during the Trump administration, has sparked significant debate about their economic consequences. Among the potential impacts, one of the most critical is inflation. Tariffs, while intended to protect domestic industries and reduce trade deficits, often lead to higher prices for goods and services. Here's why Trump-era tariffs could contribute to inflation and affect the broader economy. Higher costs passed to consumers. When businesses face increased costs due to tariffs, they often pass these costs on to consumers in the form of higher prices. For example, during the Trump administration, tariffs were imposed on Chinese imports, affecting a wide range of goods, from electronics to everyday household items. As these products became more expensive, consumers bore the brunt of the price increases. This mechanism directly contributes to inflation as the overall cost of goods and services in the economy rises. Limited alternatives and supply chain disruptions. One key reason tariffs cause inflation is the lack of viable domestic alternatives. Many industries have long relied on global supply chains optimized for cost efficiency. When tariffs disrupt these supply chains, businesses face shortages or are forced to procure more expensive domestic substitutes. This disruption not only raises costs but also creates inefficiencies that exacerbate price increases across the board. Retaliatory tariffs and broader economic effects. Another inflationary pressure comes from retaliatory tariffs. When the U.S. imposes tariffs on another country's goods, that country often responds with its own tariffs on American exports. This tit-for-tat dynamic can harm U.S. producers who rely on foreign markets, reducing their revenues and creating pressure to raise prices domestically to offset losses. For instance, U.S. agricultural products faced retaliatory tariffs from China, leading to reduced exports and financial strain for farmers. Wage price spiral concerns. As tariffs lead to higher consumer prices, workers may demand higher wages to maintain their purchasing power. Businesses, in turn, may raise prices further to cover increased labor costs, creating a wage price spiral. This cycle can embed inflation more deeply into the economy, making it harder to control. Long-term implications. While the initial intent of tariffs may be to protect domestic jobs and industries, the long-term effects can undermine these goals. Persistent inflation erodes consumer purchasing power, reduces economic growth, and creates uncertainty for businesses. Moreover, higher prices disproportionately affect low-income households, which spend a larger share of their income on essentials like food and clothing categories often impacted by tariffs. While tariffs can serve as a tool for addressing trade imbalances and protecting domestic industries, their inflationary consequences are significant. The Trump administration's tariffs highlighted how these policies can ripple through the economy, raising costs for businesses and consumers alike. Policymakers must carefully weigh the benefits of tariffs against their potential to drive inflation and disrupt economic stability. Segment 7. What this means for you. Now, let's bring it back to you. How would this policy affect your life? If you're a consumer, expect higher prices on imported goods like electronics, cars, and clothing. But remember, your paycheck would be yours to keep, so the extra money might balance things out. For businesses, especially those reliant on imports, this could mean higher costs. However, domestic-focused companies might thrive with reduced tax burdens and fewer foreign competitors. Segment 8. Is it feasible? The big question remains, can this actually work? Supporters argue that with proper implementation and gradual adjustments, the 10% tariff could transform the U.S. economy. Critics, however, point out the risks of inflation, trade wars, and insufficient revenue. The truth likely lies somewhere in between, and the success of such a policy would depend on careful planning and execution. So, what do you think? Could the 10% Trump tariff replace income taxes and reshape the U.S. economy? Or is this a policy too risky to implement? Let us know your thoughts in the comments below. And don't forget to like, subscribe, and share this video for more deep dives into the policies shaping our future. Thanks for watching, and we'll see you in the next video.